everybody I think here is. So I think we're good there. Okay, guys. Well, I guess we will get started. And first of all, I will introduce you guys. The food and everything is provided by Kyler Kent. He's with Goosehead Insurance. So if you guys have anybody that is needing insurance on property, he's pretty special to me just because I know his family and best friends. And so I've watched him grow up. And so anyway, thank you for the food. We appreciate it very much. Do you want to come up here and like show your face to everybody on Zoom? Okay. Oh, guys on Zoom, this is Kyler.
If you ever need a resource, nice to meet you, everyone. If you need a resource over at Goosehead, we're the largest broker in Texas, so I can shop the market for your clients, hopefully save them a lot of money, especially with home warranty, everything like that, as well as on the networking side. I love sponsoring events, going to events, and I can always help put the bill for that. So always come to me. I can let Brandy share my number and stuff in the chat.
Yeah. Definitely. I can definitely send that out too.
Good meeting everyone.
All right.
Nice to meet you.
Okay, y'all, I told y'all that I was going to be a nervous wreck. And so I'm a nervous wreck, but we're going to make this fun. And I want you guys to ask as many questions as you have. So let this be like open and just ask questions. Okay. All right. So we're going to talk about today, understanding mortgage basics. And let me go to the next slide here. So the types of mortgages that we're going to talk about our conforming conventional. We're going to talk about non-conforming conventional and what that is, FHA and VA loans today. We're going to go kind of through some of the highlights on the loan programs, but as always, if you guys ever have any questions at all, if you're, with a client or something and you're not sure about something, or they ask you something about a home loan and you don't know, you guys just call us, email us, call us, text us, whatever is easiest, and we are more than happy to answer any questions that y'all have. So I know on the lending side there's a lot, so same as on y'all side, so just ask if there's any questions that you have. Down payment, common terms on mortgage loans. Down payment, of course, that's what you're putting down on the purchase of the house. Different programs vary as far as the down payment amounts. So it can be as low as 3% down on a conventional loan, and it can be, 3.5% down on FHA. VA is 0% down, and USDA is 0% down. But of course, your down payment. Your debt to income ratio, and what that means is we have to look at your debt to income ratios on any borrower. And basically what it is whenever we pull a credit report, whatever debts are listed on that credit report, whatever their monthly amount is, that is what we have to count. And then we divide that number into their gross income. And that's how we come up with our debt to income ratio. So you'll hear that a lot as far as what the maximum debt to income ratios are. And I think that's on a slide too, so we'll go over that as well on some of the different loan programs. Reserves and what that is, you'll often hear also from lenders that will say, we need reserves. And so what that means is basically once the customer pays their closing costs, they pay their down payment, they pay everything there, then sometimes, depending on the situation, we may need funds left over in their account. And what that is basically like 1 month of their principal, interest, taxes, insurance payment. Okay. So you'll sometimes hear that from a lender that will say that. And then credit score, what the minimum credit score requirements are. Each lender has different credit score requirements, but for us, we can go down to a 580 on FHA, VA. Yes, just FHA and VA. And then 620 credit score is our requirement for conventional loans. So different lenders have, some lenders require a 640 or a 620 going FHA, but we can go down to a 580. So that helps a lot. If we are at a 580 though, they have to have 10% down instead of the 3.5% going FHA. But that's definitely something that we like, because it just, you know, broadens everything on what we can qualify for. Common terms, APR, you'll hear that. You'll hear people that will say, well, why is my APR different than my interest rate? And basically what it is I tell everybody, I'm like, your interest rate is your interest rate. So that is what you're fixed in at. That's what your payments are being based off of. The APR, it's always going to be higher than the interest rate. And what it is, it includes all the closing costs. So if somebody were to finance all their closing costs into the loan, if they were to finance, it takes into account the discount points, origination fees, all the fees included is in the APR. And so of course it's going to be, and it's over the life of the loan is how it's calculated. So it's going to be way higher than your actual interest rate. So I tell everybody, don't look at that. Just look at your interest rate, because that's what it is. Commitment letter, that's issued by the underwriter, and it's golden. And we like to do that a lot on our files, especially if we have like a to be determined address. If somebody's out shopping, then we'll go ahead and send the file into underwriting, and we can get the underwriter to give us a credit approval, which basically means that they've reviewed credit, they've reviewed everything, the whole file. The only piece of information that they need is once they're under contract, then we order the appraisal and the survey and title work. And as long as all that's good, then you're golden. But if you ever see anybody that gives you a pre-approval letter, that's an actual commitment letter from the underwriter, and it'll actually say it's a full commitment letter, that's golden. So what else? Closing cost, of course, that is all the fees as far as your discount fee. You've got your title fees, you've got your appraisal, survey, prepaid. So your taxes, insurance, and all that stuff is all included in your closing cost. And then seller concessions, we'll go over that as well, the different loan programs and what, how much the maximum is that a seller can provide toward closing costs. It's different amounts on different loan programs as well. So we'll go over that too. Yep.
Anything but chocolate.
Right. Yep.
Have a loan program where it allows you to say also cost. I like a seller's finance is like the most common thing for somebody to do that.
Yeah. You're correct on that. So yeah, it's everything that's into it.
We can't finance it all unless it's like a refi.
Yeah.
So APR is just there.
Yeah, basically. Okay, y'all. VA mortgages. Who is eligible for a VA? Of course, your veteran is eligible for a VA loan. Somebody that is active duty is eligible for a VA loan, and then your reservist, my Lord, and National Guards. What we do, or any lender is going to do, is once that we get somebody's DD 214, which is their piece of paper that shows, you know, that they've been in the service, we do what's called a certificate of eligibility. We run it through VA on a VA portal, and it will tell us, number one, if they're eligible to get a VA loan, because some aren't, depending on like how long of service that you have been in the VA. Sometimes you can get it, sometimes you can't, but it'll tell us if they're allowed to get it. It'll also tell us if they have ever had any VA loans before. So just because somebody has a VA loan does not mean that they cannot have another VA loan. So you'll hear that sometimes. People will be like, well, I've had a VA loan before. Thank you. Does anybody want any coffee? No? Okay. Thank you, dear. Closing costs cannot be rolled into a VA loan. No, it cannot. But the seller can pay up to 4%. I think that's on the next slide, as a matter of fact. No, maybe it's on a different slide. But it can, thank you. They can pay up to 4% towards your closing cost. And One thing that is required on a VA loan is a pest inspection. So if you guys ever have a VA loan, make sure that you get a pest inspection because it's required that you have to have it.
Are widows of veterans, are they?
Yes. Yes. Yep. And we would do the same thing. We would pull one of those certificate of eligibilities. But yes, a widow is, yes, you are correct. Now, if you have somebody that is, let's say their boyfriend or significant other is a veteran and the other person wants to be on the loan with them, you can't. They have to actually be legally married. So, on a VA. What else? Debt to income ratio typically on a VA mortgage is 28%, which is your front end. And what that means is that that's your housing ratio. So if you take the housing payment, divide it into the income, then 28% is about the max of what you can be at on VA. And then the back end ratio is 44%, which is where you take all their debts and divide it into the income. And that's about the max that we can go on that. Sometimes we can go a little bit higher. It just depends whenever we run it, if the system likes it. And if you know it's a pretty strong borrower, then sometimes we can go higher than that. Cash reserves, once that we run it through this system, it's going to tell us if they need reserves. So if they need extra income or extra assets in their accounts after closing, it's going to tell us if we have to have that or not. Let's see what else. And of course on VA, it does have to be their homestead. So they actually do have to live in the home. It can't be like, you know, a vacation home or investment property or anything like that. But let's say that let's say that you have a VA loan and the person ends up moving, but they want to keep their house and they can, then they can do another VA loan as long as they're going to live in the new house. So their old loan can be a VA loan and the new loan can be a VA loan too.
And they can rent that other house out?
Yes.
At that point?
Yep. So they're free to do whatever. So it's a pretty good program. I know that there's a lot of people that, you know, are kind of worried about VA loans. The appraisals, of course, on the houses, any government loan that you have, FHA, VA, any of those are going to be a little bit more strict on the property, the condition of the property. And I think there's a slide in there too for you guys that kind of goes over FHA and what's required like on houses and stuff. And that's typically on any of the others. Yes, Tyler?
Someone asked me this the other day, and I just didn't know the answer. I know you said active duty for VA loans. Is there a certain tenure?
I don't know that. I don't know. I know that whenever we run it through, it'll tell us if they're eligible or not, but I don't know the particular time frame on that.
So I've been asked that a couple times.
Yeah. Just tell them that we'll pull a certificate of eligibility and it'll tell us if they're eligible or not. We just need that DD 214. Yes.
For them to be in versus if they fought in Iraq or
Yeah. Yep. That is true. That is true. Yeah. There you
What
go.
about dishonorable discharge?
It's probably like X. Nope.
What about honorable, but they were only in for like a year and they got hurt?
Same
There's like
thing.
different levels, right? When you
Yeah.
pull it, it'll tell you
Yeah.
what they can discount as well.
Yeah.
Because I know a 21-year-old that was just in for like a year and a half and got hurt. He's honorable discharge.
Yes. Yeah. And for some reason that is sounding familiar. Oh, 90 days.
But it's National Guard and Reservists. I think it's like 6 years or something.
Okay. See, I'm learning something new. Let's see what else. Does anybody have any questions that's on Zoom?
Brandy, when somebody asks a question that's there, could you repeat the question so we could hear it?
Yes. I'm so sorry. We were
That's
talking about active duty, how long that you had to or non-active duty, how long that you had to have been in to be eligible for a VA loan. And what was it?
I think it's 90 days continuous service.
90 days continuous service, active
Active duty. And then
duty,
If it's National Guard or reservist, it's 6 years.
and then National Guard or reservist is 6 years. But again, we can, whenever we get their DD 214 and we run it through this system to get a certificate of eligibility, it'll tell us if they can go with it or not. Or sometimes it'll come back and say that they need more information. And so sometimes we have to go back to the customer and say, you know, the VA is needing whatever they may need. And then they'll come back and tell us yes or no. We've had that happen before too, especially like on a widow. Sometimes they'll say, you know, they need more information. And it's typically pretty quick too, whenever the turnaround for them to come back to us to let us know. So,
And land is completely different from home buying too, like a VA loan for land. is completely different.
yes, she was saying that land is completely different on VA than it is like an actual house. Oh, hang on. Oh, what's going on there? Oh my, hang on. Okay, here we go. VA does have a funding fee and it's financed into the loan. And it depends upon if it's your first time to ever have a VA loan or if it's, you know, your second, third, fourth time to ever have a VA loan. So the first time use is 2.30% of the loan amount. And again, that's financed into the loan. So the veteran doesn't actually, you know, have to come up with the cash for that. But VA does not have mortgage insurance. So they have the upfront funding fee that's financed into the loan, but they don't have mortgage insurance, which like FHA conventional, if it's less than 20% down, then you'll have mortgage insurance. But VA does not. So that's a perk. There are some veterans, and it depends upon, I think I don't know if it's 100% disability, but again, when we pull that certificate of eligibility, it'll tell us if they do have to pay a funding fee or if they don't. But some veterans don't have to pay a funding fee, which is even way better, you know, than not. And then the funding fee is reduced if they put more down. So even though it's a 0% loan program for VA, the veteran, you can put more money down if you want to. And the funding fee is a little bit less for that. And same thing on reservist and National Guard. I don't know why that keeps doing that. Okay. Escrows are mandatory. So taxes and insurance and their payment is included, and it does have to be that way. The only way that somebody can waive escrows, which means, you know, if they want to pay it at the end of the year, whenever it's due and not have it in their payment, the only way that you can do that is if you have 20% down. Otherwise, you have to have your escrows in your payment. That's not on VA though. VA does require, it doesn't matter how much you put down, they still are going to require that you have escrows. Also on FHA, so it's conventional is the only one that you're able to waive escrows on if you have 20% down. On VA loans, a VA appraisal is actually required. So VA has their own appraisers, unlike, you know, like Brian Bentley, like if he's not a VA appraiser, but he's like a, you know, a regular appraiser, but VA does have their own appraisers that actually go out and appraise the properties. What else? Can be fixed or an adjustable rate mortgage. We don't see adjustable rate mortgages very often just because the rates have been so low that it just really hasn't made any sense. We may start seeing them a little bit more now that rates are going up, but on a VA loan, you can have, it can either be a fixed rate or it can be an adjustable rate mortgage. Maximum loan amount for a VA is $647,200. Where that number came from, I have no idea, but it's the same as on a conventional loan. So on a conforming conventional loan, the max is $647,200. If you're over that amount, then you're going to be considered as jumbo. which has different requirements, more down payment, better credit scores. You usually have to have quite a bit of assets for jumbo. But 647.2 is the magic number. Each year that changes. And each year, of course, it has been going up. For the longest of time, it did stay at 417. And then with the prices of homes and everything else, then it's been going up, up, up. So 647.2 is the magic number on that.
You can get a secondary loan on it.
Yes, absolutely. Preston said he was saying that you could do a second loan to not go into a jumbo loan. So you can. We've actually done that before, where we will do like an 80% loan, and then we'll maybe do a 15% loan for a second. Sometimes that makes sense. Sometimes the payment's actually better to do that. And then other times, you know, it's not. But yes, if you don't want to go jumbo, then we can look at doing that. Definitely.
On ARM, is it, so do the rates change based on the economy, or do y'all have set places where the rates will change?
Typically, he was asking about arms, if there's like how they're figured. Basically, most of them are like a 5-1. So what that means is that in 5 years, then it will adjust. And usually it's like 1 point over whatever the rate is, their current rate.
And can you refinance that?
Absolutely. Yeah. He was asking if you could refinance an arm, and yes, you definitely can do that too. Yes. Yeah. And that is typically, that's why people get into an adjustable rate mortgage, is because either, you know, they're usually, it's your people that aren't planning on staying in the house for a long period of time, and they're going to get out before that 5 years is up or whatever. It could be a 3-1 or it could be a 10-1. There's so many different ones that are out there. But either, you know, they're going to be selling it and getting rid of it, or they're expecting a big chunk of money, you know, at some point, like a bonus or something, and then they're going to refinance it at that time, but they want the lower rate to begin with. So typically that's why somebody would go that route.
Can you get that loan
No. Yeah, it would have to be a fixed rate. All the grant programs, all of them are fixed rates. And so your first would have to be a fixed rate too. Yeah. Any questions with you guys? No? Okay. Oh, go ahead. Nope. Okay. Bill, why does that do that? And here's where we were talking about the seller concessions on a VA is limited to 4%. And so it can include your closing cost. It can include repairs that may not be required. It can include patio furniture, anything like that. And then, of course, your termite inspection, like I'd mentioned, is required on a VA loan. Next, FHA. So again, we can go down to a 580 credit score on FHA. Debt to income ratio is typically 28% on the front end, 45% on the back, but we can actually go up higher than that. I think that's a little bit older. We can sometimes go up to 56% debt to income ratio. So sometimes you'll see somebody that is going FHA, and long time ago, a lot of people went FHA because of the down payment was lower than, you know, conventional or any of those. But you may also see somebody that's going FHA because their debt to income ratio is high and we can't go conventional financing. So FHA is a little bit more lenient on not only the credit score, but also on their debt to income ratios too. So you see a lot of people that qualify for an FHA loan, whereas not so much on the conventional side. What else? Maximum loan amount is determined by the county loan limits. And again, that too changes usually every year. I actually pulled that. Hang on, I'm going to tell y'all. So I just pulled Grayson County, Fannin County, and Cook County, and the maximum loan amount for FHA on that is $426.80. So you can actually go up to $420,000 on an FHA loan. Collin County and Denton County, I pulled those just to see what the numbers were there, and it's actually 450, 800. So depending on the county, depends upon how high that you can actually go on FHA, but that's a lot higher than what it was. It was like 2 something, I believe. No, last year it was actually 3 something, but it keeps going up too, of course, because of the housing markets. Disputed accounts and collections have an impact. So if somebody, when we pull credit report, if they have collections, if they have more than $2,000 in collections, then we have to count a 5% payment against them. So that could like be a, what am I trying to say? That could be a hamper on even getting them improved if they have a lot of collections. And disputes, same thing on that too. If somebody has, you know how you can go to the credit bureaus and say that you're going to dispute something or whatever. So it'll show up on the credit report. And if the balance is over $500, no, it's $1,000. It changed. It's $1,000. If it's over $1,000, then we have to basically then do what's called a manual underwrite, which requires more documents from the customer. It requires them to have reserves. They can't have any late payments within the past 24 months. So if somebody does have a lot of disputes, sometimes what we will say is go get those disputes removed, like go get them taken back off your credit report. But a lot of times what happens when they do that is their credit scores are going to go down because it's not a true, if they're disputing something, the bureaus are, it's not a true reflection of what their credit is. And so when they get it removed, then a lot of times it drops their scores. So,
Brandy,
Yes.
a bankruptcy.
One more time.
What about a bankruptcy?
Yes. So on different, she was asking what about bankruptcy, and in the package, and Renee, BJ will send this to you guys once that we're done with the call and everything. But in your package, there is a bankruptcy chart in there. Each loan program requires different amount of years. For FHA, I believe is it 2 or 3 years for FHA? I'm not exactly sure, Renee.
Doesn't it depend on what type of bankruptcy you have as well?
Yes, and it does. Eli was asking, does it depend on the type of bankruptcy? And it does depend upon that too. But yeah, different loan programs require different waiting periods. So we'll get that to you, Renee, because I can't remember off the top of my head on FHA what it is. It's either 2 years or 3 years after a bankruptcy.
All right, I'll look for the packet.
Okie dokie. Yes. Conventional is 4 or 7 years, I believe. It depends upon the type of the bankruptcy. Yep. It's crazy. Well, every time. Okay. A lot of this I've already gone over, but again, on FHA, minimum down payments 3.5% down. Gift funds are acceptable, so they can get a gift from mom, dad, aunt, uncle. It has to be a relative that's actually gifting the funds, or a significant other. Like if somebody has dated for a long period of time, then we've actually taken pictures on Facebook and said, yeah, they've been together like for a long period of time. They're actually together, and so that's worked before. Yeah, or common law, any of that. Escrows are required, so taxes and insurance have to be included in the payment. FHA does have what's called an upfront mortgage insurance premium. So kind of like on VA funding fee, FHA has a upfront fee as well that's financed into the loan. But then also, in addition to that, there is monthly mortgage insurance as well. And I think I'm probably going to jump too fast, but on FHA, your monthly mortgage insurance premium stays on for the life of the loan. So unless if they refinance later on into a conventional loan, it's going to stay on there for forever until it's actually paid off. On a conventional loan, once that you have 20% equity into your house, then you can ask to get the mortgage insurance removed by getting just a new appraisal to verify, the value's gone up. Or once it reaches 78%, automatically it falls off. So it's not forever like FHA is.
So FHA, even if you refinance it,
Into another FHA loan, yes.
but if you finance it into a conventional.
Right. Right. Yep. So she was asking if you refinanced it like a FHA loan back into an FHA loan. Yes, you're still going to have mortgage insurance. If you finance it into a conventional loan, then depending upon the loan to value, you may or may not have mortgage insurance. But again, if you do at the very beginning, it's still going to go away once that you reach that loan to value percentages.
Okay.
Question? Anybody? Nope. Okay. Escrows are required. I think I already said that, didn't I? Sorry. FHA, it can be a fixed rate or it can be adjustable rate mortgage as well. Maximum loan amounts vary by county. So that's where we were talking earlier about those amounts. Cash reserves is determined by the AUS, is automated underwriting system. So once that we pull, there's two different types. There's what's called DU and there's one that's called LP. Different mortgage companies have different requirements as far as which one can be pulled or can't be pulled, but we can pull both DU or LP. Sometimes you may get an approval on DU, whereas sometimes you won't on LP, and vice versa. But we can pull both of them to see, which one will give us an approval, so we can go with that. But then once we pull it, it's going to tell us typically if your scores are lower, then you're going to be required to have cash reserves, which is again money left over after everything is paid. But then if your scores are higher, or sometimes we just don't even have to have that, but it will tell us.
Rental property. So if you were like buying a duplex that you're also going to be living in, would that be considered as a rental property if you're using that rental?
No. And that's a good point. As far as on a duplex, on FHA, as long as you're living on one side of that duplex, we can go FHA all day long. And that, you can rent the other portion out if you wanted to. It's a great, yeah. And we've had customers do that a lot.
So you can't buy a duplex as an investment property with an FHA.
No, you cannot. So yeah, FHA is just like VA, it's your principal residence. So it has to be your principal residence. Now, can you have another FHA loan? So let's say that you have an FHA loan now, and let's say that you want to keep that house and you want to purchase another one. You can have another FHA loan as long as, number one, either we have to prove that your situation has changed. Like, let's say that you're having a baby, or you've got more kids, or whatever, you just got married and you have more kids. If you need more room and we can explain that, then you can have another FHA loan. Or the other thing is the distance between where you work and where your home has to be more than, I believe it's 90 miles. And you can have another FHA loan. So otherwise you can't. Yeah. Yeah.
Would it be easier in some cases just to refinance to a different loan program if you're wanting to do FHA backup?
If you can, yeah. But a lot of times the reason why people go FHA is because typically either their credit scores are lower or their debt to income ratios are higher. 90% of the time, that's why you see somebody go FHA, is because of one of those two things. Not all the time, but most of the time, that's why you would see that. This slide is in here just because prior to, I guess it was 2013, the mortgage insurance premium was not life of the loan. And so it depended upon, how many years the term was, what the loan to value was, but now that's changed. So that was just put in there. This is the chart that I was telling you guys about as far as if your property will pass going to FHA. This is a really good little chart that you can look at, once that you have a house that you're listing or something. Basically what FHA is looking at is the safety and hazard. So if there's like any hazards to be had, if there's cracked windows, if there's exposed wires, if there's, a bathroom that's not complete, then typically on FHA, it's not going to work. Whereas on conventional, they're a little bit more lenient on a lot of these things. But this is really good, just kind of, checklist just to look at to see if you go and list a house and some of these things are, on there, then you'll know that it's probably not going to go FHA unless if the seller fixes the stuff. Yeah, okay. Seller consent, what time is it even? Okay, I'm good. Seller concessions on FHA, the seller can actually contribute up to 6% of the sales price towards closing cost. The buyer still has to come up with a 3.5% down, but they can pay up to 6% in closing cost. You're not seeing that as much now as you used to. We used to see it a lot, and now it's like, no, because they don't have, it's a seller's market. So what else is on there? And the 6% does include, like, if they're doing repairs or closing costs, decorating allowance, patio furniture, anything like that is included in that 6% for FHA. This little chart is FHA and conventional comparison. So again, on your FHA, you can go down to a 580 credit score. Conventional, the lowest is a 620. So again, that's a lot of the reasons why people go FHA. On FHA, 3.5% down. Conventional, you can go down to 3%, as long as there's different loan programs for that too. One is if you're a first-time home buyer, which basically just means if you haven't purchased a property or had a property in your name for the past 3 years, then you're a first-time home buyer. You can do the 3% down. The other way to do 3% down going conventional is income. So if it depends on the county that you're in, but there's an actual income limit. And so if you're below that income limit, then you can do the 3% down and you don't have to be a first-time home buyer. Otherwise, it's 5% is the next down payment for conventional. On FHA, of course, you've got your fixed mortgage insurance options, which is, for the life of the loan. On conventional, there is no mortgage insurance requirement. Again, if you have, 20% equity into the house, then there's not mortgage insurance. What else? On your FHA, of course, again, it's owner occupied only. So your primary residence on conventional loan, we can do vacation homes, investment homes, primary residence. And let's see, and then your bankruptcies, of course, it depends on the loan program as well, as far as how long that the bankruptcy had to have been discharged before you can go the loan programs where you can get qualified. Same thing on conventional mortgage. Again, credit score 620, debt to income ratio is tighter. And so it's 28% to 45. Sometimes we can go up to 50%. Just depends on how good their credit scores are and what they're putting down and all that stuff. But it is tighter than FHA. And then your maximum loan amount is 647 too. So as long as you don't go above that, then it is a conventional loan. Conforming conventional loan. If it's over that amount, then it's jumbo. That we went through there too. As far as the reserves may or may not be required, just depends on when we run it. Again, escrows can be waived at 20% down. If you don't want to include your taxes and insurance, then as long as you have 20% down, you don't have to. Mortgage insurance on a conventional loan, it's not fixed like on FHA. So there's different rates And the way that's ran is it's basically based upon your credit scores, your debt to income ratios, the loan to values. So it may be higher on Will's than it is mine, but it's just because of those different things on conventional. What else? Seller concessions on a conventional loan is if somebody puts 5% down, then the max that the seller can contribute is 3% towards closing cost. If they put 10% down, the max is 6%. And if they put 20% down, then the seller can pay unlimited. There's not a percentage max on that.
Wow.
Yes. Documents needed. So this is basically talking about in order to get like a pre-approval letter. So I think we talked about this last week, or Michelle did, but pre-qual versus a pre-approval. So pre-qualification is basically all it is we've taken the application, we've pulled the credit report, credit looks good, what they put on their application as far as their income and all that stuff, everything looks good, but it's not verified. So pre-approval is what you want. Always, always, always make sure you get a full pre-approval letter. And what that means is, and we do all pre-approval letters because we get documents from the customer. We will get their pay stubs. We will get their W-2s. We'll get the tax returns. We will get their bank statements to verify that they actually have the assets in their account to be able to use. So once that you actually get a pre-approval letter, that's what that means, is that the lender has verified all their information. Income calculation, and that's a big reason of why we do get the documents from our borrowers, is because let's say you have somebody that's self-employed, because that's typically what happens, and they say that they make $10,000 a month. And we run everything at $10,000 a month and they're fine. The ratios are good. Everything works great. But let's say that you go a step further to do the pre-approval and you get their documents, you get their tax returns, and you see that they have all these write-offs. So their bottom line, their net profit of what they actually say that they made is, let's say, $5,000. Well, that could really that could definitely hamper your pre-approval letter if you don't have everything. Same thing.
And they're figuring now that you can go look at 24 months of
Bank statements.
to kind of, even though the IRS, on your report you say this, but on your bank statement it proves that you made.
Yes, there are. We actually have a company that we are brokering with that will allow you to do that. So yes, she was asking about bank statement loans. So on self-employment, we have a loan program that's coming out that we're brokering with that will actually take bank statements and look at that to see, to help make up, what their income is instead of just what their tax return says. What else? Overtime, bonus, commissions. Sometimes we can count it, sometimes we can't. So, you may have somebody that'll say, oh, I work 20 hours of overtime a week, and they put that on their application, but then they've only been at their job for 6 months. We can't count it. So we have to have a 2-year history of overtime, and we have to have a 2-year history of bonuses, commission, anything like that has to be a 2-year average. So that could definitely hamper things too if somebody puts that on there and then we get the documents and we're like, oh, we can't count that. What else? I think that's really all on that. Child support and alimony, kind of the same thing. Sometimes we can count it, sometimes we can't. If, let's say, you're getting child support but the child support isn't consistent, you might get it, 1 month and then 3 months later not receive it until, the month after. It has to be it has to be consecutive. And you've had to have received it for at least 6 months before we can count child support. What else? Oops, hang on. debt calculation. So again, anything that is on the credit report. So it's going to be your credit cards, your installment loans, autos, anything like that, business loans, you know, whatever the monthly payment is that's reported on the credit report, that's what we use to consider for the debt to income ratios. Qualified mortgages, all that basically means is that we have verified the ability for the borrower to repay the debt. What else? This is talking about the, yep.
I heard the other day, I was just watching a snippet on something and it was saying, and I don't know if you've heard this, I want to ask. Have you heard anything about people not paying child support, not getting off like the military or things like that? Like they haven't been paying it and they're supposed to be paying it, they're denied because they owe child support?
Yes, yes, that is
So that
true.
is a thing.
Yes,
Okay.
it is. She was asking about if you had somebody that is supposed to be paying child support, but they're in arrears and they haven't paid. Yes, they have to have paid child support. Same thing with your IRS tax liens. If there's tax liens that are out there, those have to be paid too. Or they have to have an arrangement set up with the IRS. Yep, yep. You're right on that. This is talking about the 3% down. So what I was saying as far as either you have to be a first-time home buyer to do the 3% going conventional financing, or there's income limits that that are there for the 3% down. Oh my goodness. And then the 10 commandments. So we always send this to all of our people once that they're under contract. We're like, do not change jobs in the middle of this process. Do not go buy a vehicle. I actually had that happen to me one time. And I show up to closing. No, it was the day before closing. The customer comes in to bring some documents or something, and there's new plate tags. And I'm like, please tell me you did not go purchase a vehicle. He was like, oh yeah. It's a lower payment. And so, yeah, I traded in my other one. And I'm like, no, you're going to have to go take that vehicle back. Because he was like, but it's a lower payment. And I was like, but this is what he did. So he owned his own business, and the vehicle that he currently had was in the name of the business, and the business paid that. So I did not have to count that debt. And so when he went to go buy a new vehicle, the payment was lower, but he put it in his personal name. So therefore I would have had to have counted that payment. And I'm like, no. You're going to have to go take that back. And literally he was able to do that. Or actually, I think what they ended up doing was just holding off and just didn't run it through until after closing. I was like, I don't care what happens after closing, but right now, like, no, we cannot do this. Furniture, you'll have a lot of people that'll say, can I go, buy some furniture before closing? Well, that could mess up your pre-approval because, if they go put it on a credit card and their ratios are already maxed out, then we've got to count that payment. And we do pull credit before closing. So, and oh, there we go. There it is. So we do pull it 5 days before closing. It says 5 days. We may actually do it 3 days. It just depends on the loan program of when that does. But if there's any new inquiries that show up on the credit report, we have to verify indeed that they haven't taken out new debts. And if their balances change over $1,000, then that can mess up things too. So I always tell everybody we do pull another credit report before we close. So just make sure you don't do anything stupid that's going to mess up everything. And then what else? Verify transactions on bank statements. We do. If we see somebody that the underwriter looks at their bank statements, and if we see somebody that has, a $30,000 deposit, but yet their payroll checks go in every month and they're, $1,500 to $2,000, and they're going to ask, what is this deposit? And they have to verify, where it came from. So a lot of documentation. Oh, I think that's it, y'all. Any questions for anybody?
You're good.
No, that was good.
Oh. Thank you. Thank you.
You
and
did
it's-
great, Brandy. You did great.
Oh, thank you so
Enjoy over
much.
time.
Thank you. Thank you. Thank you. But guys, again, anytime that y'all have questions, holler at us. We are more than happy to help in any way that we can. So, no questions
Oh, you did good.
come to mind? No? Right. Good deal. Good deal. Do what?
Come on, Brandy.
Ah, no, y'all have no idea. I literally could like hear my voice cracking, and I know my neck's red too because I don't like to be put on the spot. I get very, very nervous. But
Good.
good. Hopefully, you guys got some good stuff out of
Did.
this. But
Good.
later on, even if during the day, if you think about something and you're like, I'm not too sure about that, holler. Things change all the time too. So we literally, I feel like sometimes we're like an attorney because, you have to look up guidelines all the time because they change so often and just so.
Large amounts of money in your checking account.
Mhm.
If someone is selling property and say they're gonna pay, $60,000, and they plan to go to a home. So is that you have to explain, or is it gonna?
Yes.
Well, we can see where the funds came from.
Yeah, so we would just require a copy of as long as you can prove that where the funds came from, so a copy of their HUD, then yeah, it's fine. Now, what we do tell people is, she was asking about if somebody had as far as on the checking bank statements, if somebody sold a property and they put a big chunk of, funds in their account, as long as we have a copy of the HUD that shows where those funds came from, we're fine. Same thing if they go and sell a vehicle, let's say, to use for a down payment or whatever for their loan. We do have to actually have a copy of the bill of sale to show that they actually sold a vehicle. And we have to get the value off of is it Blue Book or whatever, just to show, that it is, valued at X amount of dollars. But what I do tell a lot of people is, because you'll have people that have mattress money, they have all this cash and they're like, well, yeah, I have all this cash. I can go deposit it into a bank. We're like, no, because we can't trace where those funds came from. So if it's cash, what I tell everybody is live off your cash. So keep depositing your payroll checks, but live off your cash. Do your groceries, do your bills, do everything off of cash, and just keep depositing your payroll checks. Only other way to get around that is if the funds are seasoned. So let's say that somebody put cash in today and 60 days go by, then we're okay. And we don't have to verify it. But anything before then, we have to verify where those funds came from.
Yeah, we do that.
Yeah, get a gift. Yeah. Yes. Yeah. And we'll say that too. If, somebody just has a crap ton of cash, but they don't have funds in their account, then we'll say, do you have a grandpa or grandma that'll maybe, your mom, dad, somebody that'll gift you the money and you can give it back to them. But
But they can gift up to like 10,000 a year.
without tax penalties or whatever. Yeah.
Like they have-
Really nice grandpa right there.
Yeah. Yep. You're right.
Do they have to show a gift letter with that? Like even if they do it every January, like they're wanting to get your inheritance to you. Because I had some friends that did that.
Mhm.
You have to show, like if you bought a house in December from January, do you have to show that gift letter or is that past the time?
Yes, we do. So anytime anybody does get a gift, there is a gift letter that basically just says that it is a gift. They don't have to repay the funds back. Now, if you do or don't, that's between them, but
Just be written on a notepad.
no, there's an actual form that they sign. Yep. So And on FHA, we have to verify that the donor, the person that's gifting the money, actually has those funds in their account. And sometimes that's kind of a problem, especially if you have somebody that's private and they don't want to share their information with you. You'll have a lot of people that'll be like, I ain't gonna do that. And used to, you could get away with just getting a letter from the banker, just having the bank just write a letter stating, you know, that Mr. Joe Smith has the sufficient funds in his account, the account number to gift the funds, but now you can't even do that. We have to have the bank statements to show that the funds are in the donor's account. Conventional, it doesn't matter necessarily. We have to have the gift letter, but we tell everybody for the donor to just issue a cashier's check at closing, and then we don't have to verify it. So crazy. So crazy to keep it all in your head to remember everything.
Yeah.
Do what?
Don't keep it in your safe or your mattress too long, it gets all moldy.
Molded. Yep. Coffee can.
And nowhere to keep money, man.
Less can pouches.
Right. Well, guys, I thank y'all so much for being here today. And Michelle will be back next week. Hallelujah. Hallelujah. So appreciate you guys. And if y'all need anything, holler.
Thank you, Brandy.
Thank you, guys. All right. BJ will send y'all everything later on today. So you'll get copies of everything. Okay.
Bye, baby.
See y'all. Bye.
Thank you.
Thank you. Hang on.